Our club's always been a forum for visionaries, public figures, and decision makers to command attention to the issues of our time and inform the most relevant, compelling, and challenging conversations. Here we offer first-person access to dynamic political, business, and public personality.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon again. We're ready to get back underway. Hopefully everybody enjoyed lunch. We had trouble getting people out of the social hour into the lunch and then finishing up lunch and getting onto the talk. So I know that everybody's enjoying themselves and we're having a great afternoon, and it's about to get a lot more interesting. Special welcome to those of you joining us online at CanadianClub.org. Thank you for spending some of your afternoon with us. My name is Glenn Parkinson, Canadian Club Toronto President and your host. And I want to remind and just thank that all of our events, in-person, online, and hybrid like today, require the support of our sponsors. So today's event is made possible by EY and TD, so thank you for your support. We're also grateful to Canadian Bankers Association, our season sponsor, Air Canada, our airline partner, and Canada's Forest Trust, who partners with us to offset the carbon impact of our entire season. So thank you for your partnership. In just a moment, we'll introduce our guest of honor, but before we do, I want to remind you that Canadian Club always encourages questions and interaction from our guests. So what questions might you have for Rogers CEO and President? Question cards are on the center of your table. They're about this, like the size of a recipe card, if you can find them. Fill out your question. Hold them up, and we've got volunteers who will run and bring them up to our moderator and try to work them into the discussion. Similarly, for those online, there's a button on the right-hand side of your screen saying, click to submit questions, or use that, and we'll bring the questions up. And now, I am pleased to invite David McQueen, Managing Partner for Consulting of EY Canada, to introduce our guests of honor. David.
Well, thank you, Glenn. Good afternoon, everyone. It is a pleasure to be here with you today. EY is proud to be supporting yet another Canadian Club of Toronto event, and we are extremely delighted to be a sponsor of today's meaningful conversation with Tony Staffieri, President and CEO of Rogers Communications. Today's theme is investing in Canada for Canadians. The telecom industry in Canada has a major impact on the lives of Canadians each and every day, playing an essential role serving as the backbone of the country's digital infrastructure. Simply put, the hyperconnectivity of our daily lives wouldn't be possible without the investment from companies like Rogers. For context, the telecom industry currently contributes approximately $75 billion and 600,000 jobs to the Canadian economy annually. And those numbers will only continue to grow as fast and reliable telecom services become a necessity for nearly all businesses coast to coast. That's why we often consider telecom as a horizontal and not just a vertical industry. It is through this digital infrastructure that other industries like mining, banking, and healthcare can make investments to adopt and integrate new technologies like artificial intelligence to improve productivity and innovate their offerings to remain competitive in a global market. Serving as the fabric that connects various sectors, it also plays a pivotal role in driving forward economic development, technological advancement, and societal transformation. For Canada to compete on a global stage, we require bold and visionary leadership. Rogers, under Tony's stewardship, is at the forefront of investing in the infrastructure required to help Canada reach the economic needs of the future. His bold leadership led Rogers to complete its momentous merger with Shaw, the largest in Canadian telecom history. Last year alone, they invested more than $3 billion building out high-speed networks across Canada, innovating by adding 5G splicing to their networks and partnering to offer greater connectivity to Canadians to remote communities through satellite technology. With significant investment in both wireless and wireline networks, as well as continued investment in innovations like artificial intelligence, the Internet of Things, 5G, Rogers is enabling new services like wildfire detection and prevention technologies that drive forward the sustainability agenda. By strengthening the telecom environment, Rogers is playing an integral role in shaping the future of our country for the benefit of businesses, consumers, and helping Canadians realize their full potential. In today's conversation, we'll hear directly from Tony more about how Rogers is driving impactful innovation and deepening its investment in Canada. Outside of Rogers, Tony is a passionate supporter of local communities. He chairs the Toronto Municipal University's Board of Governors and is a board director of Maple Leaf Sports and Entertainment. So Tony, thank you for the win last night. Tony will be joined by Andy Willis, business columnist for the Globe and Mail, for an interactive Q&A session. So with that, it gives me great pleasure to welcome to the stage the President and Chief Executive Officer of Rogers Communications, Tony Staffieri.
Thank you, Dave, and thank you to the Canadian Club for inviting me back, and thank you all for being here. It's good to see you all. It's hard to believe it's been 1 year since I was last here, and how much has transpired over the course of the year. At the time, the ink was still drying on the Shaw transaction, and we were coming out of a regulatory fog that was an overhang for a little over 2 years. I remember being both relieved and excited to bring together two iconic entrepreneurial companies. It was a $20 billion deal, so this was no small feat. Ted Rogers and J.R. Shaw were pioneers who built Canada's communications landscape. They were legends in our industry and in our country. So it wasn't lost on Edward and me that we needed to get it right. Looking back, it's hard to believe how much we accomplished. We integrated the two companies, delivered $1 billion in synergies well ahead of target plan, and we're 6 months ahead on our integration plan. Overall, we're meeting or exceeding our commitments. I'm incredibly grateful to Edward, our board, and our entire team for their relentless commitment. At the same time, we turned around the performance of the company. We went from last on almost every key value metric to now leading on almost all of them. We delivered 9 straight quarters of growth, and we attracted the most internet and postpaid wireless customers in our industry. We did this while making record investments in infrastructure and innovation. Last year at Rogers, we invested 90% of our profits back into Canada, into Canadian networks, Canadian content, and Canadian jobs. We're a proud Canadian company, and we invest for the long term. We just released our first economic impact assessment as a combined company, and together we supported 92,000 jobs and contributed $14 billion to Canada's GDP last year. Investing in our networks is the foundation of everything we do. Connectivity plays such an integral role in the lives of consumers, businesses, and economies. But if you leave with one thought today, it's that we're more than just a communications company. We're an entertainment company as well. And through our media brands, we reach over 96% of Canadians. We operate where entertainment and connectivity meet. Canadians are consuming content more than ever, and entertainment is being viewed differently. Try mentioning must-see TV Thursdays to your kids, and they'll have no clue what you're talking about. They go from live TV to on-demand, to highlights, to streaming apps. Canadians are chewing up bandwidth like never before. They're flipping back and forth between Wi-Fi and wireless. Content and technology need to be integrated in a seamless way. The network running in the background, the technology, it just needs to work and always be on. The content, it needs to draw the viewers in, and it needs to capture their imagination. There's no point, though, if you can't find the content. Roughly half of all Canadians say they can't find the content they're looking for. And that's where Comcast comes in. Last week, we announced a 10-year agreement with Comcast to bring world-class Xfinity products to Canadians. Comcast is a world leader in technology, and Xfinity connects over 50 million homes and businesses globally. Their new entertainment platform will bring live sports, entertainment, news, on-demand, and streaming apps together into one simple viewing experience. Canadians will spend less time searching and more time viewing. And the foundation for this new experience is 10G internet. It will deliver multi-gigabit speeds, ultra-low latency, and even better reliability. With 10G internet, we will bring Canadians the most reliable internet experience, period. And we will converge our 5G wireless network and 10G internet so we can seamlessly connect customers in and out of the home. As a sports owner, broadcaster, cable company, internet and wireless provider, we take a macro view. It's why we announced a deal with Amazon last week in the NHL to bring Monday Night Hockey to Prime Video. It will bring the game to more fans across more devices, and it's a perfect fit with our Comcast roadmap. The world around us is evolving, and we're evolving with it. Thank you.
Well, thanks, Tony, for the overview. And as Dave said, thank you for the win last night, because had the Leafs lost, my first dozen questions and probably most of this chat would be on how do we fix this team. But clearly, Leafs are heading to the Stanley Cup Finals. All is good in the world. Rogers Centre feels great. I was at baseball last night. If you haven't been, get down there. So we're going to leave the sports alone for a minute. Okay. I want to pick up, though, on something Dave was saying, that internet and that everything that Rogers does on telecom is now essential to the overall economy. And you talked briefly about, your 10G commitment, the kind of improvements you're making in the system. And I was at the annual meeting last week, and it was all future-facing. Exciting rural developments to ensure that high-speed internet is available in communities where it hasn't been available in the past. Your investment in 10G. At the same time, you're carrying an enormous amount of debt from the Shaw transaction, and you're paying it down aggressively. So I thought, just as for this crowd especially, can you just talk about, as a CEO, how you balance your investments in the future and honoring Ted Rogers' idea of the best is yet to come with the realities of your balance sheet and of just doing business? How, as a CEO, do you make decisions on allocating capital?
Well, we think about it in sort of three major categories. And on the closing of Shaw, large deal that was largely funded with debt. And job one was to integrate the two companies and be focused on that. And the guiding principle, sure, there were the synergy targets and other financial KPIs that we wanted to meet. But the way we went about it was to focus on the customer first. This was going to be a win if a customer felt as quickly as possible they were dealing with one company. So that was our guiding principle on the integration. So first and foremost, it was about the integration. And you heard some of the comments in terms of we achieved the synergy targets well ahead of plan. The integration of back office and a number of other things is well ahead of plan. So that integration was one. The second piece of it is turning around our performance. And what do we need to do to go from lagging to leading in market share in every one of our key assets? And then the third piece is making sure we have a balanced cash flow view. And so when we closed Shaw, our debt leverage ratio was 5.3. We're down to 4.7 now, with a view to aggressively get that down to 4.2. And next year we'll be into levels that are probably about where our competitors are today. And so it's come down quite aggressively. So it's been in those three categories. And the last one was really based on making sure that we had a good capital allocation program in balancing EBITDA growth with paying down debt and making sure we had money to invest in capital. We just think now is the right time to double down on Canada. And so those were the priorities and how we thought about it.
So one of the commitments you made in the Shaw transaction was, to increase competition. And part of that obviously was the sale of Freedom Mobile to Quebecor. That was a condition that the government put on the transaction. What I'm reading from the analysts and what I'm seeing, frankly, in Rogers' stock price is that competition might even exceed what the government has expected. There's been real, especially with the flanker brands, real competition in wireless, low pricing, and that's reflected in results. Can you just talk a little bit about the competitive landscape right now in terms of what it means to consumers, but also what it means to Rogers and as a company in terms of your financial results?
A couple of things. In coming together with Shaw, there are a couple of things that increase competition, and the real increase in competition is what we now, Rogers, together with Shaw, brought to the West. It's worth repeating, as we went through our court case with the government, the judge was very clear that, in his conclusion, this was going to be pro-competitive for the West, because now we were going to have an alternative to TELUS, where we could put together wireless and cable offerings. And you see that in our results. The West is now our fastest growing. So we talk about cost synergies, but the real upside for us is gaining market share in the West, and that's what we're doing. And so bringing choice to Western Canadians was important. On the wireless side, and that's where you were going, Andy, we previously had 4 players in the wireless space, and we continue to have 4 robust competitors in the wireless space. It's worth mentioning that that's against a backdrop of an addressable market that keeps growing. If you were to look at population growth, both new to Canada as well as organic, and we measure it by number of SIM cards, frankly, number of cell phones. Last year it grew at over 5%, just phenomenal growth. We haven't seen those growth rates in a long time in this country. And this year we expect it to be somewhere around 4.5%. So very good growth. So, I'd say we continue to have healthy competition against a backdrop of healthy growth. And then the last point I'd leave you with is, when you think about market structure and the competitiveness of a 4-player market, I always remind folks, just look south of the border. 10 times size of market, and they recently went from 4 to 3, and everyone would agree that is still a very competitive market. So we think we've got the right market structure. Our job is to lead in market share in that competitive structure, and that's what we've been doing. And so when you look at the financial results vis-a-vis the competitiveness, you see a few things. One, we continue to lead in market share across the country, and that's been driving leading revenue growth. We're committed to operate efficiently, and so competition makes us better and it makes us more efficient. And so we have leading margins in the industry and leading cash flow. And so all of those contribute to what I would say a good investment thesis in terms of Rogers. And when you look at the analyst reports, 13 of 14 have Rogers as a strong buy, with the other having the whole industry on a hold. So that's pretty good. It's unheard of in terms of that support. But to bring it back to your comment, what does that mean for valuation? I would say the whole sector has really been dampened by market forces that are outside of our control. And so we stay focused on the things we can control, which is let's stick to the fundamentals of our business. Let's continue to improve performance. And long-term shareholders understand the importance of those value metrics. And we continue to have good support from long-term shareholders.
So you mentioned the U.S. experience, and I'd like to just talk about that a little bit because our experience usually is what happens in the States will eventually come to Canada. In the States, you've got a pure play wireless T-Mobile that's grabbing market share from some of the cable operators, and the trend in the States obviously is towards cutting the cable. Now you've got the benefit of having a multi-dimensional platform. You know, you've got a wireless product, you've got a big commitment to cable. But can you just talk a little bit about how you're thinking about the future of cable against a competitive landscape where there will be more options for traditional cable subscribers?
Yeah. I mean, in context, unlike the U.S., Rogers would be one of the few in the world that has national scale of wireless and national scale of cable operations as well. And so we see a world where one isn't going to substitute the other. The technologies will complement each other in an ecosystem, and soon satellite gets added. Yeah. If you just think about the sheer amount of data you use in a home, you'll have the average today is over 20 connected devices in a home. You might have at least one and maybe 2 or 3 people in the household that are doing Zoom calls or Microsoft Teams calls. That's a lot of bandwidth to go over the network. To try to do that at scale for an entire city, there just isn't enough wireless capacity to do that well. Especially in Canada with the spectrum limitations we have vis-a-vis the US. And so as consumer and business demands keep increasing, you know, interesting stat, over the last 5 years, the amount of data usage in Canada has grown 200%. That's how fast it's growing, and it's getting faster and faster. You know, today we have a run rate of about 50% on both wireless and cable in terms of data growth. So the capacity you need, you're always going to need a cable network to carry that much capacity. And so it's going to be more about how do we have seamless integration between in the home and out of the home, and this whole idea of convergence, and eventually with satellite as well, is the roadmap we see. So that's kind of on your first question in terms of, you know, how do we see cable and wireless? And so they'll continue to coexist and continue to grow. The second piece is, you know, this notion of cord cutting, which really is, for those not familiar, it's a term relating to the number of TV package viewers that are disconnecting and going to an alternative. And I would say we've already made that transition. If you're to look at our cable business today across the country, we are predominantly an internet company. That's where we get most of our subscribers, that's where we get most of our revenue, and frankly, cash flow. And so the way we think about it and the transition we've gone through is it's internet first, and then there's all the things that ride on the internet that makes Rogers more compelling. First and foremost, we got to have the best internet, and we'll continue to invest to do that. And our 10G roadmap puts us there. And then we surround it with the products, and that's where the Comcast Xfinity products come in. It's adapted to the way folks are viewing content today. As I said in the opening remarks, the biggest feedback we get from customers is, I can't find it. Yeah. And one of the advantages that we have on the Rogers Ignite is you can just pull up the show by saying it. Well, the new platform, it goes to the next level. And when you want to watch something, you're not going to know whether it came from Netflix, Amazon, Apple, or it's streaming on linear TV. You just know it's there. And if it's a game and you want to watch the game and it's on, and you're in the 4th inning, but you want to go back to the beginning, you just say, bring me back to the beginning, and you don't, it'll pull it up without you having to worry as to whether you recorded it or not. So our vision is, and that's part of the entertainment experience we have. And so as we think about, because we're content owners as well, so we think about it as internet first, and then bring the platform that is going to allow Canadians to experience entertainment as simple as possible. And it's an add-on feature in our cable business, just like home monitoring is. And you know, the app that we've got there, which is the Xfinity app, and it integrates with all the other home products like Ring, Google, et cetera, into one interface.
So as someone who spent 20 minutes trying to find a show called Ripley because I couldn't remember what streaming service it was on, I can't wait for that product. I actually have seen the product in Rogers Labs. It's very, very cool. Let's talk a little bit about disrupting yourself, because that's kind of what you've been doing in a number of industries, but you mentioned the Amazon transaction. So Amazon Prime Video will now cover 26 games of Monday night hockey games that in the past would have been on your Sportsnet network. So you're taking programming off your own network, moving it on to Amazon Prime Video. Like, what's the thinking behind subsidizing a streaming service that I could argue is a competitor to Rogers?
For those not familiar, you may have not seen it, we announced a deal last week with Amazon, where as part of our NHL content rights deal, Monday nights will be on Amazon Prime exclusively. And so by way of background, we've had the NHL rights now for 10 years. We got 2 more years to go, and it's been a terrific contract for us in terms of growing Sportsnet. And we've done a lot to grow the NHL brand and viewership in Canada. So it's been a real successful partnership between us and the NHL. But we're also sports owners.
Right.
And so it's always in our interest, just like it is for the NHL, to always look to increase audiences and viewership. And I don't think anyone debates the power and reach of Amazon Prime across the country. And so here's an opportunity to actually increase reach in partnering with them. And so it's just one more example of us moving with the way Canadians actually want to experience and view content. And it dovetails with the announcement we did on Comcast Xfinity and the platform that I just talked about, where you'll find it wherever it is. And the Amazon relationship isn't a new one for us. You may recall last September, we were the first to put Sportsnet on Amazon Prime. Again, it's all about increasing audiences and increasing reach. And so it was a very strategic partnership for us.
Obviously, this is your meeting, not mine and Tony, so please, if you do have questions for Tony, send them up. There are people around, and I've got one here. Rogers has had 9 successful quarters of growth, leading Bell and TELUS. What do you think are your headwinds and your tailwinds in 2024?
Well, the tailwinds, I'll start with that. We continue to see a growing market, and that's good for our industry. And it really comes from population growth, and on the cable side of the business, it's population growth, but importantly, housing supply. Housing supply has consistently been about 2%. Last year would have gone up slightly to just over 2.5%. Housing supply is a big issue. You know, as I meet with premiers and municipal leaders across the country, everyone's looking at how they improve housing supply. And so in outer years, we see the possibility for an uptick in that housing supply. So we operate in what I would call a growing market, and that's good. That's been healthy, and the new to Canada category in particular has been good for us. We focused on it, and we have leading share in that. And so those are some of the tailwinds we have. When I couple that with a number of the competitive advantages that we have, I think we're feeling very good about our ability to continue to lead in market share. Of course, we keep an eye on the competition and where we think they're going. But the other piece of it is continuing to work with all levels of government and ensuring that they have a vision and a view, which they do, that competition in Canada ought to be facilities-based. And so if you want to compete in the sector, you've actually got to invest capital, and we think that's good. At-risk capital creates healthy competition. And so, you know, those are the ones we're focused on.
Since you mentioned the government, you know, your friends over at Bell have said they're going to cut back on capital spending in reaction to some of the regulatory changes. A tactic on Bell's part that I kind of question, but can you just talk a little bit about how you're thinking about capital spending with the way that the regulatory framework is evolving?
A few things there. One is, when we think about infrastructure and capital spending, we think in 20 and 30-year cycles. That's the time horizon we always think about. And so if we think about it in that context, we have a country that's growing faster than it has in a long time. So that's one. Technology is evolving very fast. If you think about even 5G, which has been around for a few years now, there's new technology like network slicing and a number of other things that we need to continue to bring to Canadians. And in the overall scheme of long-term cycles, we still have a relatively low cost of capital. And so our view is now is the time to invest. And we're fortunate that with the performance of the company, notwithstanding the debt we took on with the acquisition of Shaw, if you look at how much we spend on interest and dividends, it's about half of what Bell and Telus paid as a percentage of EBITDA profitability. And so we have a very balanced and prudent cash flow model that we're focused on that allows us to make sure we have what we need to invest.
I can tell in audiences like this that someone out there is a banker. How do you plan to, or a lender rather, how do you plan to reduce your debt to a debt to equity ratio from 4.5 to 3.5? And maybe I'll just go a little further. You've outlined probably $1 billion worth of non-core asset sales over the course of this year. Do you want to just talk about lowering debt and where you stand on non-core asset sales?
Yeah, we've been committed to get our leverage. As I said, at the time we closed the Shaw transaction, our debt leverage ratio was 5.3 times. We committed over a few years to get it down to pre-merger levels and be in line, if not lower, than the competition. And so the biggest driver has been EBITDA growth. We did say we would sell $1 billion of non-core assets. Most of that is real estate. We have quite a bit of real estate throughout the country that is excess real estate for us. And so we've been going through a process. Shortly after we announced the sale of the assets, we saw softness in the real estate market. And so we continue to work those, and we're committed to realize that $1 billion in asset sales, but we're being patient, and we have the opportunity to be patient because of our EBITDA growth. And so when you look at debt leverage, EBITDA growth is actually the bigger factor to get those ratios down. And so I put it in perspective, $1 billion of asset sales would take our leverage ratio from 4.7 to 4.6. Right. $1 billion of EBITDA growth takes us from 4.7 to 4.2. So you get 5 times the impact, and so we're doing both, but the bigger facilitator for delevering is going to come from EBITDA growth.
The question here, slightly, I hope you're ready for this one. What are the plans for Rogers Bank? Is this an area of growth for the company?
Absolutely.
Okay.
A lot of folks probably in the room didn't know or don't know that we have a bank license and we've been operating a credit card. And over the last year, we've really, I just got to make sure I've always got my Rogers card with me. There we go. Thank you for the question.
Marketing.
What we decided to do with the credit card is actually integrate it with our core products. And so, again, as part of our innovation, it's not only innovation on technology, but what are consumers really looking for? And one of the things that was an obvious for us is cost of handsets. As they continue to rise, in our industry, we're limited to amortizing that cost over 2 years. So what we decided to do is take the credit card, create a platform where you can get instantaneous approval in the store. You can buy the phone on the credit card, and at 0% interest, you pay for it over 48 months instead of 24. And so we cut the monthly payments in half. We combine that with a whole bunch of rewards. Through a number of venues, it's considered the most valuable credit card in the country right now. And so it's a real growth opportunity. We've got terrific management leading that. And we're quite excited about how it helps our affordability agenda.
Again, we did this a year ago. You were just getting your arms around Shaw and what you had out in Western Canada. But I know you were recently in Calgary, and at the annual meeting, you were talking about the labs that you're developing in Calgary. So can you talk a little bit about what Rogers is doing in Calgary and in Western Canada to build the network and to build your operations?
Yeah, absolutely. There's 2 things there. Last week we announced Cable Labs North. We've been a participant in Cable Labs out of Denver, and that's a global institution of all the cable operators, and it's an R&D facility. So when you think about, Cable Labs would have hundreds of patents, and when you think about DOCSIS technology and 10G, that came out of innovations and R&D done at Cable Labs in the US. And the next phase for them is they're really excited about our participation because being a scale operator of wireless and cable is how those two technologies intersect, so that for a consumer, you're just going in and out of the home a lot more seamlessly, and inside the home, you're not just on the home Wi-Fi, it knows who you are, much like it does when you're out of the home on your cell phone. And so it's that convergence that they're excited about and we're excited about. And so we're working with them to create a facility. It's going to be in our Rogers campus in Calgary, and we'll carry on the work to what we think is a reasonable amount of time, bring that convergence to market. So that's what that's about in terms of that specific investment. And then we continue to invest in rural expansion in the West, and maybe that's what you're getting at in terms of the other investments we're making, both BC, Alberta, and some of the other provinces in the West. Heavy on rural Indigenous communities and getting them connected with whatever the best technology is. Sometimes it's laying out cable and fiber, and sometimes it's using the wireless network. And increasingly, over time, that was our satellite announcement as well. An interesting stat I always quote, you know, in a country like Canada, we covered 99% of the population with our wireless network. It's only 12% of the landmass. So 88% of the landmass is not covered today, and that's where satellite comes in. So we'll move to 100% coverage, and that's the deal we did with SpaceX and Link Global. And so later this year, you'll be able, from your smartphone to where there isn't a wireless network, seamlessly connect to satellite, to text, and eventually do voice calls as well. The primary focus at first is going to be on first responders. Right. And some of that technology we've already started to use in the fire detection technology with all the forest fires that are happening. On our cell towers, we put AI cameras that can see smoke up to 20 kilometers away, connected not only to the wireless network, but to satellite. So first responders know exactly where it's going to happen. We augmented that with sensors that we developed with UBC that are all over the ground. And we started with BC, and those sensors monitor soil moisture and soil temperature so that first responders and BC forestry management have a good sense of where forest fires are likely to start and try to deal with it preemptively.
I joked off the top about, you know, beliefs and your sports ownership, but in a serious vein, Rogers and Bell to a lesser extent, but Rogers mainly is a unique telecom and media company in that you actually do own the sports, and you actually did last week's annual meeting in the Sportsnet studios. Can you just talk about how you think about sports ownership as a part of the larger strategy for what you're doing at Rogers?
We're a communications and an entertainment company. And so we think about sports ownership as one of the fastest growing entertainment vehicles, frankly. And so when you look at sports teams, the value of sports teams continues to go up, and sporting events are still the most watched events, particularly live. And so it's a good asset to own. And through our interest in MLSE, as well as ownership of the Jays and Sportsnet distribution, we're the largest sports owner in the country, and they're valuable assets. And so we see them as very strategic to our core business, and we're proud to continue to hold them, and we plan to continue to hold them and continue to invest in them.
And I know it's looking ahead, but Rogers got the exclusive NHL deal almost 10 years ago. That will be up for renewal after the 25-26 season, I believe, 24-25 season. What's your general thinking around broadcasting the NHL and around grabbing those broadcast rights, which are steadily getting more expensive?
As I said, that's been a terrific deal for us, the NHL deal. It's a 12-year deal. We have 2 more years to go. Both us and the NHL are thrilled and proud in the way audiences have grown and the innovation that we've brought to the distribution of the games. So as we look to contract renewals, it's something we're very interested in and something we will chase and certainly expect to be at the table.
And would you think of that as the next time around, rather than being an exclusive deal, that there's potential to bring in other partners, that a streamer, or a partnership with another platform that to widen the audience base?
Yeah, I always like to talk strategy, especially amongst 250 friends. And
on an event 2 years in the future, I get you. Yep.
So we got a ways to go before I can answer that. Yeah.
Got it. The other, maybe we'll take it back to the numbers just for a minute, and then and again, I'd welcome questions for all of you. But you did announce quarterly earnings last week. By and large, ahead of forecast on the integration of Shaw, as you just highlighted. What else is going on at the company that's sort of revealed in the numbers that you would want this audience to understand?
Well, I think a couple of things, when you look at the release of the results, one is continuing to lead on customer share, which is translating to leading in terms of revenue growth for the industry. The most efficient operator, so we lead in margins, and we lead in actual investment in CapEx. We see it as a good thing, and we've talked about earlier from your questions, why now is the right time to invest. And we think it continues to put us in a leadership position, while at the same time aggressively reducing our debt leverage. So a few things to note. One is the performance. Two, the Shaw integration. We announced the $1 billion of synergies. We said it would take 2 years, and we did it in 12 months. So well ahead of plan, and it really speaks to the execution discipline of the executive leadership team and the entire management team at Rogers and the frontline folks. There's just been a real disciplined focus on the customer and what matters most, and it's resonating. The value propositions are resonating with the customer, and you see it in share. And so, I always say this is a serious company with serious operators, and you're seeing it in the results, and you saw that again, 9th consecutive quarter. And that's at the same time that we're bringing down leverage and announcing innovation at the same time. Things like the TTC that we continue to invest in. It's hard to believe for 10 years there was no cell service in the TTC, and so we were really proud to do that. We announced and talked about Comcast Xfinity. I mentioned network slicing, which is on our 5G network, being able to create lanes that are dedicated. So first responders aren't going to be getting congested on the network because someone else is trying to stream something on home internet through our fixed wireless access product. And so a good steady stream of new products and innovation for consumers and businesses would be the other highlight from last week.
Thanks, Tony. And if there are no further questions from the floor, I'm just going to go back to where we started when Dave said Rogers is an essential industry. The work that you do is the backbone of this country. You support all of us as consumers. You support every business represented in this room. So we wish you all the best in ensuring the network is robust and growing. And I really appreciate your transparency and your willingness to be here and talk about what's going on at a really important company. All the best.
Andy. Thank you all.
Thank you, Tony, and on behalf of the club, I just want to say thanks again for deciding to join us and share not only the progress you've made with Shaw, but also the way you're reshaping the telecommunications and entertainment industry, investing in Canada. It's an inspiring story, and we're really glad to have you here again. And I, for one, look forward to year 3 of the Staffieri Update series here at the Canadian Club. We'd welcome you back, and Andy as well. Always a pleasure, so thank you again. 3 things before we close. One, first of all, we'd like to thank EY and TD for sponsoring today and making it possible. And then a couple of events upcoming this month. So on May 9th, we're hosting a thought-provoking panel on increasing Canada's economic resilience. May 23rd, we have the 2024 edition of our Private Equity Outlook. And May 30th, we will host a discussion on employer-funded healthcare. Please visit our website at canadianclub.org for more event details. And I'll finish by saying thanks to VVC Live for broadcasting today's event live and making it available to everybody for free. To those of you online, thanks for joining us. And to everyone in the room, have a wonderful afternoon, and we'll see you again soon. Thank you.